Hey there, listener. I want to thank you for listening to the National Land Realty Podcast. Now, please remember to like, share, and review our show. If you can, take a second, hit pause, and give us a quick review. It only takes about a minute to write what you think about the content that you hear on this show. Good or bad, we want to hear it. Thank you in advance. Now on with the show. Welcome to episode number 24 of the National Land Realty Podcast, where we discuss all things land. Our goal here is to inform, educate, and entertain those of you who own land or are interested in the buying and selling of land throughout the United States. My name is Mac Christian, and I am the Chief Marketing Officer here at National Land Realty. I'll be your host for this episode. Now, in this episode, we'll be talking with Dr. Gary Schnitkey of the University of Illinois about land values in 2023 and what has been influencing those values. This is an incredibly valuable conversation and a level of insight that is hard to find anywhere else. Dr. Schnitkey uses farm business, farm management, that is FBFM data on revenue and cost to analyze profitability of major field crops and to assess impacts of farm programs and risk management strategies. His research informs farmers of the most profitable rotations and encourages long-term change to impact yield. Gary is renowned far and wide for his knowledge, so this is a real privilege. Now sit back and enjoy the show. I am talking to Dr. Gary Schnitkey out of the University of Illinois. And Gary, if you could just really quick, tell me how you got here. Tell me how, you worked your way up through the ranks of academia in agriculture and sort of walk me through a little bit.
Yeah, so I grew up on a grain and hog farm in Northwest Ohio and decided to go to the university, and I went to Ohio State. And I was going to be a veterinarian and then discovered that economics is a whole lot easier than chemistry. Got a bachelor's in ag econ, came out to the University of Illinois and got my PhD. And then I was on faculty at Ohio State, and I was a dairy farm economist for 10 years. And then in 1998, I came back here and have been a professor in farm management here and look at crop economics in the great Midwest.
Excellent. So in looking at your background, you kind of just hammered all of the academics out there right out of the gate, right? You went for your bachelor's, master's, and PhD consecutively, right?
So, yeah. And if you have to remember when I graduated college was just 1982. You remember that period? The job market wasn't that good. So
that was coming off the Carter administration into the Reagan administration, off of a pretty heavy downturn, right?
Yeah. So jobs weren't all that plentiful. I liked the college life, and they paid me to go to school. So there we go.
That sounds like that's a smart play right there, given the economy. And I came out of college too, right in front of the huge crash that we had in 2006. And that's when I first hit the market right out of college. And so, and I was really smart about it and went into marketing, which is always the first head to roll. So I would say you made a much smarter decision than I did, because it was rough there.
Yeah. So yeah, it's worked out pretty well. So it's been a good career.
Awesome. Well, I've done a good amount of digging on sort of a lot of things that you speak on. You've testified before Congress. You're in front of farm boards regularly. You're advising, landowners throughout Illinois. Quite a background there with what would you say you specialize in? And I realize corn and soybeans are definitely, what you talk about a lot, but sort of what's sort of your specialty when you're producing, research or speaking to landowners?
Yeah, so I describe myself as a crop economist, and given that we're in Illinois, which number one crop is soybeans and number two crop is corn, and actually we have close to 22 million acres here in Illinois, and those are the two major crops by far. I focus on corn and soybeans, crop economics in those areas, but particularly looking at risk management. So I do a lot of this thought and discussion about crop insurance, and I've been involved in those crop insurance discussions farm policy and how, the commodity title programs and how they impact risk, marketing strategies and how that impacts risk, and then land tenure or controlling land and how that impacts risk. And at the same time, anytime you begin talking about those and risk, you sort of get involved in looking at where prices can go in the future and what farmland's doing. And it's a very interesting, very interesting area. So I've enjoyed it.
I would say so, especially in the last 3 years because of the price fluctuations that we've experienced, right?
So nothing's been normal since about 2018, and I'm waiting for a normal year. 2018, we had the trade embargo, Trump. 2019, that continued, and we had MFP payments, and then we had a really bad spring season with a lot of prevent plant. Got through that. In 2020, we introduced COVID and the control measures, and that threw us around for a while. And 21 and 22, then we have this Ukraine-Russia thing. So I'm looking for a normal year again, whatever that is.
And it's one of those where that phrase keeps jumping out there, the new normal. And I don't think I can hear that phrase anymore. It's so hard to hear. Because it's like, what does that even mean? How do you work with that? And I was just going to say, I keep on catching myself. So if it comes out, I'm going to pre-apologize. So I live in Idaho, and everybody always calls Idaho, Iowa, if they're not from Idaho or the Northwest. And I keep on catching myself almost like there's multiple states that I keep on almost saying instead of Illinois. So if it comes out, I apologize. It's just, it keeps on, I keep on catching myself. So if it happens, just like, throw something at me through the screen or something.
There we go.
Hey, so you mentioned, the key events since 2018 and, we had a new administration. What did those embargoes do to croplands in your area and then sort of what you saw nationally that you saw in 2018?
So 2018, it actually caused a pause in increase in farmland prices. And we were actually pretty concerned about where those were going to go. That embargo in particular hurt soybean prices because we export in this country 50% of our soybeans, and a lot of those go to China, and that was a major target. What smoothed that was the MFP payments, the Market Facilitation Program payments, which were quite large. So those came in and slowed, or they made up for the income loss due to price declines, and they were a stopgap measure. And I would say those caused farmland prices not to decline. I mean, if you look at it, farmland prices have been on a steady upward trajectory since mid 2005, 2006. So they sort of slowed in that era, and you were wondering, well, is it a good thing to anger your major market for your soybeans? But we seem to have gotten through that pretty well, and China has decided they can buy soybeans again from either Brazil or U.S., so they don't care.
Yeah, we sort of made friends back up in the last couple of years. Well, not friends, right? But we opened some trading.
Yeah. We're okay being enemies just as long as you buy our soybeans.
Exactly. Yes. Yeah. So we've gone through that. We've gone through, the COVID chaos, and I don't know that you can necessarily attribute, any steady. It's hard to talk about the time period that all the COVID restrictions were in place, just because it was so out of the blue, and then it seemed to go away, and now we're sort of in the aftermath, right?
Yeah. So immediately when COVID hit, we were very concerned about, in particular, corn price, because you make corn into ethanol. Fuel demand went down. And we saw, again, corn prices decline pretty dramatically from March of that year till August. And then something happened, and they began going up again. That was, I guess, COVID turned out not to be as bad as maybe we thought on the demand side for things. And China began buying again, and they began rebuilding their herd. So on the demand side, it turned out not to be as bad as we thought. However, I don't know. I don't think Midwest farmers are all that different from everybody else, but I think COVID really hit our supply chains and made life harder. I mean, we and this isn't going to be any different from any other business, but you can't you can't get parts from machinery. I mean, it's delayed, and anything you want to buy is delayed. Herbicides were a big issue.
We heard a lot about that during the last couple of years, and coming up into 2022 as well. It's been a conversation that's been pretty prevalent.
Yeah, and then that sort of began the rise in fertilizer prices, because COVID slowed maintenance of nitrogen fertilizer plants in the Gulf area, Louisiana, Mississippi, and they had to do maintenance in mid 2021, and lo and behold, a hurricane went through there, and that further delayed that, and that's when we began seeing prices of nitrogen fertilizer increasing.
So, and I've read through some of your papers on this, and it actually, I want to say it shifted my opinion, but really it was just a matter of me educating myself, right? And a lot of what in discussions that we have on crop prices and land prices, a lot of the attribution goes to they'll talk about fuel, or they'll talk about, the price of commodities have gone up because of the lack of imports from places like Ukraine, Russia in the last couple of years. But you touched on, the price of ammonia because of how it goes into the production of nitrogen fertilizer. I didn't realize that natural gas plays such a strong role of that, and a hurricane going through the supply chain and wrecking that up. So a lot, and then a lot of the conversations go to, they talk about administration policy, how, we've cut domestic oil production and how that fed into things. But when you really look at it, it has more to do with disasters hurting the supply chain up front. And it was just, I really appreciate your research there, because I kind of dove into that and really kind of like, oh, I got a quick education on that. So if you could touch on that, that would be great.
Yeah, no. Nitrogen fertilizers are important for corn and wheat, and the production of those occur in plants. A lot of the production occurs in plants in Louisiana and the Gulf area. But a prime ingredient in fertilizer production is natural gas. And natural gas is used to make anhydrous ammonia, and then from anhydrous ammonia, we get all these other different fertilizers. But so what happens to natural gas is extremely critical in nitrogen fertilizer production. And so any blip that impacts natural gas, and so, whenever pipelines in Oklahoma and Texas shut down, that's a big deal. And all of that, and then the Gulf area was again slowed down because of COVID and the need to do maintenance. And then you have Hurricane Ida hit, and all of that's not a good thing, and spiraled up natural gas prices. I'm not going to totally take away the blame from cutting back on petroleum production, though. That's probably not a good thing. If you're
yeah. So how much does that play in? Because we're in the age of I would say like crazy partisan politics, where everyone just kind of throws rocks back and forth at each other. But let's remove that from the conversation as I'm, is best for everybody. But how much does the administration changes that we've seen in the last couple of years regarding natural gas and fuel, how much does that play into the cost increases that we see, not necessarily in crop yields or, any like the transporting of crops, but we're talking like the production, like what you're talking about here, and the overall cost to produce crops?
So, I don't have a model that breaks that down quite as precisely as you would like it. But if you look at natural gas production, and we've got a good supply of natural gas because we did fracking for a long period of time. Well, if you tell the producers that, hey, we're going to try and end your industry, it doesn't give you a lot of incentive to invest in it. And oh, by the way, we have rising interest rates, which makes everything more difficult to invest in. And there was, as you might say, there was some irrational exuberance among the natural gas producers beforehand that led to some losses. So all those things sort of move in together. It's not inconsequential what the administration has done. And, it might be a 10, 15, 20% of the cost increases that we've seen. And if you don't, all right, moving forward, you got to seriously think about what are you going to do with natural gas? Because Western Europe doesn't want to buy it from Russia anymore, for a good reason, by the way. Mm-hmm. I mean, if I were them, I wouldn't want to be right now, Western Europe totally depends, or not totally, but
40%, right?
Yeah. Depends on Russia, and you don't want to be in that position. Well, if you don't depend on Russia, you got to get it from someplace else, and it's a world market. So we better produce more of it if we want to keep prices in a range that keeps our economy going.
Right. And if we want to, another part of that too is like, it's just the politics of the situation. If you want to keep your political allies really good friends, become economic partners, and then we're reliant on each other more. That's, and hopefully we're not as abusive of a partnership as the Russia-Europe partnership has been. But you're right. We have to look at fuel production in there, which I love that conversation. So as it relates to land, we go through all of this. We go through the COVID epidemic. The supply chain is just absolutely messed up at the end of COVID. And then they release all the restrictions. The supply chain gets worse because when you go from 0 to 100 miles an hour with no warning or preparation on infrastructure, you're headed to a mess. And so the last year and a half have been sort of a mess, right? Mm-hmm. And I guess coming into that, then you have Russia, Ukraine, and that's, what is it? 30% of the world's wheat supply and natural gas throughout Europe. You have, what's their other key products in Ukraine? I know wheat, barley, I believe is a big one.
And they have oil seeds as well. They're a soybean producer and sunflower and canola. So they're a major oil seed. Ukraine is a breadbasket of Europe. So you take that out, you're going to have an impact on a lot of things. But wheat is the one that immediately gets the attention because they're a major wheat producer, and a lot of that goes to countries that are poorer and need those calories to keep their diets going.
So when that supply shuts down, that puts a lot of pressure on countries like us, right? And it drives our prices up. So we have increasing expenses to maintain crops and increasing prices in crops. Are those balancing out?
Yeah, so far. And that's exactly right. Ukraine did both, right? On the positive side for U.S. farmers, from an income standpoint, they did increase commodity prices. wheat, particularly corn and soybeans. And at the same time, they did increase cost, and in particular, fertilizer cost, because again, Russia is a major producer of all fertilizers, and so you take them, make their product harder to get, take Western Europe and slow the supply of natural gas. So any nitrogen fertilizer manufacturer in Europe now has difficulty. I mean, you have a choice of either heating homes or making fertilizer. Your first choice is probably going to be heating homes. So it does raise costs and just adds uncertainty. So, all right, what does that? So the land market then, at least in the Midwest, went crazy the last year, right? We've had 20, 30% increases in land prices.
So I know that Illinois experienced $1,000 per acre increases over the last. Sorry, I've got my dog just went crazy in the background. That might continue for a little bit. She's deaf, so she doesn't know when she's barking. So Illinois had pretty substantial increases, but then when we look at Ohio, we look at Nebraska, where they're up to like $27,000 an acre in some areas. Yeah. Illinois is holding around. Is it around 10,000 in the higher areas?
So in the higher areas, we can be 15 to 20.
15 to 20. Okay, so it's up there too. What are we looking at? I mean, because a lot of people have spoken to the 1980s crisis, or the late 1970s, where there was sort of a they call it a bubble there. There's a lot of fear in the language people are using with those land values. And we're looking at that with the Ukraine-Russia conflict. Are we looking at a correction if that conflict ends? What's our risk areas? And this is where I really wanted to get in with you because of your background in risk management. What's sort of the outlook here?
So first off, I would say we're not looking at 1980s, because if you look at debt levels around here, they're really low.
Okay.
So we don't have people aren't going out and buying land using debt capital to do it, because lenders won't let them do it.
It's very hard to get loans for land, right? You've got to use you got to drop cash.
Yeah, you got to drop cash or equity. You got to be well capitalized. So we don't have that issue going on. If you're looking at there's two sort of longer term trends that cause you pause. I mean, how long can these commodity prices stay up at the levels they are? And ag economists like me would say the first time we get a large crop in Brazil or here, we're going to see those prices decline. Maybe that's true, maybe that's not, but that would be the trend. And then also, how long are interest rates going to remain at a higher level? Honestly, I wouldn't call these interest rates, and now I'm old, I remember the 80s. These are more normal interest rates, and your land prices have to, or you would think all asset prices sort of have to adjust to this new normal. We can use that term, new normal, higher interest rates. So, I don't necessarily think we will see a large decline in land prices, but I could see them being steady to downward, 5 to 10%, and stay here for a very long period.
Okay, so you think it's moving towards more of a sort of stabilization, more of a plateau kind of stage where, we see some, you're going to see up and down, but not as far as the high swings that we've had here lately.
Yeah, I don't see how you can keep going up, right? I mean, there's nothing fundamental out there that sees you're going up. I get the impression that there's still money that wants to come into agriculture, not because it's a great investment necessarily, but because all the other investments don't look very good either. I mean, are you going to leave money in the stock market now? I mean, that's could be just as overcapitalized as land, right? And usually, if you're looking at a turmoil, you would prefer to own a real asset than a financial asset.
Right. Well, and that's something that's been pumped up over like the last decade, right? Where you have, the when you look at market capitalizations of domestic equities, and you look at, what is it? They use like the PE ratio there to examine, where it is. Like that went out of balance 5 years ago. And then we had the yield curve invert, a few years ago. There's danger territory, but everyone keeps on like hyper rationalizing how like, oh no, it's fine. Which, that sounds like the wheels are falling off the airplane, right? Like, oh no, everything's good. Don't worry about it. It's going to be a little bumpy. There's some risk there.
Yeah, there is some risk there. So there is some risk there, and it could decline. And I think that all comes back to what you believe are going to happen to commodity prices in the longer run. And I don't see how they can stay up at the levels that they are. And if you're looking at bids for next year, they're coming down. But here's the question. We're thinking we're moving into a recession, but I suspect that recession is going to have much larger impact on tech stocks than on real assets. People still want real things, right? Yeah.
I love how you differentiate tech stock from real assets.
Yeah. I mean, that's the industry where we've seen a lot of, and I admit, PE ratios, you compare them in agriculture and you're going, yeah, they're a little bit out of line.
Yeah.
You look at PE ratios on a lot of these tech stocks and you're basing a lot of things on hope, right?
There is a lot of hope there, yes.
So that would be the one where I would be more concerned about if I was in that industry, is in that area. Because, if you look, the good thing about a recession is it wipes out a lot of false hopes. Well, there's quite a few false hopes that need to be wiped out probably in that sector. So we had the dot-com boom in the 2000s. Now we're going to have to wipe some things out.
It's going to be another, it's kind of a mass Darwinian thing that you have in technology every few years. And I think that a lot of individuals, when they're looking at land in general, it gets associated with real estate because it is, right? Like it gets sold like real estate brokers work with it, and they associate it with residential real estate, which is right now going through a heavy correction. And the difference is, you live on residential real estate. Cropland produces your food. And it has real attainable value, and it produces money, and it produces things that people need, as opposed to your house, which doesn't do any of that. But they get lumped in the same thing. And so people get the same fears about those. And it's like, well, residential is correcting. What's going to happen to land? And so going into 2023, that's sort of, you can see that fear sort of happening.
Yep. And again, there are reasons for caution. Let's use the word caution. No, again, I personally would think of a period of steady land prices to slight decreases would be sort of good for everybody. But here's not to sound like a commercial for farmland, but here's the good thing about farmland. And this happens to be from one of my good friends who's a farm manager and also had rented houses and was owned some rental properties as well. Farmland, if you're in the right area, has 100% occupancy. So you don't have to, you can get it farmed. I would look for some retrenchments of land rents in the future if you're at the high end, which there's some people at that high end. But retrenchments is better than no occupancy. So
yeah, and so feeding kind of into your sort of strengths and your background as we move into 2023, what are some of the better sort of risk management strategies that landowners, and specifically cropland owners, can execute to sort of protect themselves? Because we do have this period of, you've talked about it before, where we're moving into possibly lower prices in commodities in 2023. Once I really dialed into it when you talked about it, because I thought it was, on point and funny, is that once you raise prices for something like fertilizers, it's probably not going to come back down very easily, because that's just economics, right? Once you establish that high line, the high water mark, you don't want to pull it back down, because it's just profits, right? So that's just how it works. What can landowners, cropland owners do to protect themselves moving into 23, 24?
So one of the things that I would, cropland owners, they should probably be getting or if they haven't done so, get their cash rent set for 2023. I'm suggesting to farmers that they market more of their product for 2023 now than they usually do. That isn't necessarily a projection of where prices are going, but a note that at the current price levels, we can be profitable, and it might not be profitable as we move forward. For landowners, and they've done this already, is just to be kind of prudent with your land investment. And again, if you're a landowner, be prudent with that. And I would also evaluate where your cash rents are, or your rental rates are, relative to what could happen. Are you at the high end or at more of the mid-range for cash or rental rates in your area? If you're at the high end, you might make plans for that to come down. And make sure that you can sustain that. For landowners, over the next 5, 6, 7 years, the capital gains from land may be small to negative. And that's the environment that you're probably living in for a while. So get used to that. And I would also caution a landowner, if they think they're going to sell the farmland and invest in something that has capital gains. Remember, interest rates are going up for all assets. It probably has a larger impact on land because it's infinitely live. But you're going to face that headwind in all your asset markets. And, no. So I've been at this for a while. Most people don't know what rising interest rates look like, right? I mean, since the 1980s, we've seen those interest rates come down. We're now in a rising interest rate market, and that implies something very different about what happens to asset prices. Asset prices don't go up as fast.
Yeah. Well, and you're talking about an era where we went up to like 17, 18% very quickly. And we have people kind of freaking out right now about 4%.
Yeah.
And it's really, like you pointed to it earlier when you said it's more moving to normal than it is rising interest rates right now. But that doesn't mean anything in the future. We could be looking at rising interest rates here in the next year, right?
Yeah, depending on what the Fed decides to do, and maybe they don't even really have control. I mean, that can just happen. The Fed appears to be slowing their interest rates. I'm not sure that's a good thing or a bad thing, but that's what they're signaling.
because they took their foot off the gas here in the last couple months, right? But that doesn't mean they have necessarily a handle on inflation. Maybe they're testing the waters.
Yeah. So, and the other thing is this inflation temporary or not? And I don't see how there isn't a large, significant portion of that is longer term. There's labor's difficult. Anybody that's producing a real product probably can market it for a while. So you got this real side of the economy that looks pretty robust. And actually, most people could sell more product if they could figure out the supply chain or the labor to produce it, right? That's the holdup. It's not necessarily the market. It's, if you try and get a plumber, an electrician, or a carpenter, they're all booked up. So
yeah, I was going to say the demand is there all over the place. It's the labor behind it, and it's the getting it to the demand, right? That's a huge limitation right now.
And that's not a market where that's not a situation where you see a slowing of inflation. In those
that's not a good sign for anybody trying to slow inflation, right?
Yeah. So it's time for the real economy to bang out something, and the tech stocks to sort of retrench a bit.
Right. Which, and there is sort of a trend of people moving back into tradesmanship, or people moving back into producing, more tangible goods. That we're, it's sort of a movement, and we're seeing a little bit. It just, takes a while for that to ramp up, right? It takes a while for people to get that experience and that education, and to follow through and actually build businesses.
Yep. And what's popular one day is less popular the next. So there you go.
Very true. I work in marketing. Awesome. Well, hey, what's sort of, you're looking at 2023, and I want to make sure to be respectful of your time, because, we talked about running here for like 30, 45 minutes, and I don't want to book up your day too much. So I want to sort of get, your overhead view. 2023, are you do you think that land holds more value as a hedge to inflation and market fluctuations, or is it like an investment opportunity? You spoke to a plateau. So are we looking at what sort of situation are we looking at with land values moving into 2023?
Yeah, so I would be looking for a plateau, and I would be looking for, and maybe even a slight retrenchment, depending on what happens. But, I think it's a good place for inflation hedge and just a general uncertainty hedge. And again, if you're looking at farmland, there's going to be demand for food for the foreseeable future, and maybe even difficulties in meeting that demand. Investing in the asset that produces that basic thing is probably is a good thing to have invested in. So,
hey there, listener. Quick disclaimer. There is a feedback loop that kicks in right here, and I don't want to move forward with the podcast and pretend that it didn't happen, or pretend that, that it's a normal podcast from this point forward. We pride ourselves on quality. So there is a little bit of feedback here. It's not your stereo. It is the recording. But the conversation goes about 10 more minutes. It's just so cool talking with Dr. Schnitkey here, and we just wanted to make sure that the rest of it was captured. You can feel free to shut it off here and move along with your day, or carry on with the conversation and carry on with your listening. Thank you again.
I see it as more of a hedge. Having said that, I'm not bullish on any asset investment going into 2023. So,
Yeah. This is it's sort of looking like a hold on to your seat, kind of year moving ahead. And there's a lot of uncertainty. People are talking recession. People are talking not recession. There's a lot of signals that say recession, and given 20 years of economic growth, that's not perpetual, right?
Yeah. You do have recessions every now and then. So
yes.
And again, we probably, looking back on it, the COVID, there are costs to shutting down your economy for a while. So,
Right.
And those are what we're experiencing now with supply chain issues and inflation and that sort of thing.
Absolutely. Hey, so a couple last questions here. So as we're headed into the holiday season, what are you thankful for this year?
So I have a lot to be thankful for. Mainly what I'm thankful for is I have a little piece of land out that I can get away from this craziness. I planted a bunch of wildflowers on it this year.
Okay.
Pasture or prairie land. So this is central Illinois. So I planted a little plot of prairie out there, and I got this all situated. I'm going to enjoy watching it as we move forward. And I have my wife and family, and they're all doing well, and we're all in good health. So everything's good, and I still have a job and income coming in, and it all seems to be going pretty well.
Those are all terrific things. Are you planning on, you said wildflowers and stuff. So are you doing bird watching, wildlife, just hanging out?
Just hanging out, but just hanging out. I'm going to buy a beehive this year, so I'm going to.
Really?
Yeah, I do larky sort of things every now and then. My nephew has a beehive, and he said, "You really got to get into it. They're fun to watch." So here we go. So he actually is a farmer in Ohio, not here, but got into that because he raises pumpkins, and they're pretty important for pollination of pumpkins. And he said they're fun to watch. So I got my flowers and I got my honeybees. So
I have heard the same thing. I have several friends that have gotten into the beehive thing and making their own honey. And there's the ones that are, I found there was some beehive producers out of New Zealand that made, they're on stilts, and it's beehives where you can take it out without destroying the combs. Mm-hmm. And it's like, it's like a tap that goes into the hives. That I was watching those, and there's a glass enclosure that you can watch the bees in that look really cool. That's a fun one. You're going to do that this summer then?
Yeah. So I got my, there's a group that does a beehive education. So I got my spot all reserved. I have known nothing about this, and we'll figure it out.
I love that, man. You got to get out of your comfort zone. That's cool.
Yeah, we'll see what happens. I'm not planning on making a living.
No. I spread myself thin on hobbies too, so it's I can appreciate that.
Yeah.
Excellent. Well, hey, any last words from you before I let you go here?
Yeah, and in agriculture, we've gone through I sense we've had very good income, a little bit of unease, but let's just enjoy these high income years while they last and make some preparations for the future.
Yeah, because like you said, moving in 2023, our margins might be a little more thin, but they probably won't, crash or anything. But we're just going to be skating here, like with a little thinner margins, what we've seen this last year, right?
Yep. Higher costs, lower prices.
Yep. Excellent. Well, hey, Jerry, I can't extend enough appreciation for your time. I really appreciate it. Thank you for giving me the last 40 minutes of your life. And I absolutely just want to say thank you.
Oh, you're welcome. And thanks for having me.
Anytime. Honestly, really anytime. This concludes episode number 24 for the National Land Realty Podcast, discussing 2023 land values and what has influenced those land values with Dr. Gary Schnitkey out of the University of Illinois College of Agricultural, Consumer, and Environmental Sciences. You can learn more about land ownership and the buying and selling of land at nationalland.com. Quick reminder, please like, review, and share our show. Our show doesn't get found if people don't talk about it and hit that like button. So, if you found this show valuable, others will too. Make sure to share it. As we get reviews, we'll share them on the podcast. Now, thank you again, and we'll see you next time.